Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, from China's release of its latest trade data to markets cheering on Japan's Prime Minister's resignation, it seems like this week is nothing short of a rollercoaster ride for market watchers. So how exactly should we be digesting news of these latest economical developments? And as valuations of US stocks continue to fly high, are there any other opportunities in the markets like in Asia that's worth a second look? Let's find it all out with Martin Hennecke, Head of Asia and Middle East Investment Advisory at St. James Place. Good morning, Martin. How are you doing today?
Good morning, Dan. It's a pleasure to be on the show, and very well today. Thank you.
All right. So happy to have you on with us. Now, we first turn our attention over to China, where trade data of the second largest economy was just released. While exports continued to rise by 4.4% in August, it seems like the figure was significantly lower than the 7.2% that was recorded in the previous month in July. And it also fell short of expectations. So how exactly are you reading China's slowing exports growth and trade surplus? And to what extent is this likely to impact its GDP growth target of 5%?
Yeah, great question. And I think, to be honest, some of those headlines flashing the drop in export numbers is misrepresentative. So firstly, I'd just like to highlight the trade surplus was 102.3 billion. And trade surplus is on track to be the largest ever in the history of China for this year, even beating last year's close to 1 trillion. So a lot of countries would kill for that. So in terms of the exports, with Donald Trump in charge in the White House, there's going to be a lot of distortions when you just look at month on month. If you're looking year to date versus the prior year, exports are actually up 6.9%. Even if you're looking month on month, there's a big highlight that should be made there. There's a drop in U.S. exports, and there's very strong exports to ASEAN countries, Europe, and, a lot of other emerging markets. So we think it's not something to be, hugely concerned about or to read too much into this. In fact, let me give you one other number. Last month, the International Federation of Robotics revealed preliminary figures of industrial robot installations, and China had a 54% share of all global industrial robot installations, so more than the rest of the world combined. And it just shows you their industrial might. And, we think there's still great opportunities. And I think a lot of people, when they see those headlines, underestimate China's real economic size and power.
Fantastic. Thanks for bringing up that figure, robot industry and landscape. That perhaps might be something worth watching out for. Now, Martin, sticking to China, let's look over to the stock market, where it seems like optimism is returning to the Chinese nation. While the mainland's CSI 300 benchmark index traded flat for the first half of this year, June alone had seen the index posting double-digit gains, and today the index is up more than 15% from June. So what's been driving China's double-digit rally, and how sustainable is it?
Yeah, that's another one of those somewhat misrepresented headlines. Sometimes when you read, some of them nowadays, it actually says, China's stock market is overheating, it's in another bubble. They can hardly do it right, because just a few months back, China was still uninvestable, and the very, very depressed valuation was supposed to be, having a reason because it was uninvestable, and then it rallies, and then it's too hot. So it's kind of a tough one. But let me just recap. One of the main reasons for the rally was very, very low valuations to start with after long-term underperformance versus the U.S. market. And then, the country has been doing really great in lots of sectors, EV, AI, high-tech. But, I just mentioned the industrial might, but also other areas like high-tech drug development that people aren't even aware of. So just last year, China, in terms of new novel drug developments, overtook the EU, and they're chasing the US now. So there are good reasons for it. Surely go all in China. We are always a bit cautious when things are getting more popular. We like more depressed things, but we still see great opportunities. Investors should always diversify, though, across different styles, different geographies, asset classes, and never speculate short term, especially not with leverage.
All right, that's a great point that you raised there, Martin. Now let's shift gears over to Japan, where we're witnessing the unexpected resignation of Prime Minister Shigeru Ishiba. And for some, this political reckoning comes at a time when the country is already grappling with hot-button issues like inflation, tariffs, and of course, the wildcard, President Trump. What's your assessment of Prime Minister Shigeru Ishiba's resignation announcement, and why are investors cheering on that news?
Yeah, so I give you my quick take on that specific news, and then there's something very much missed, I think, else about Japan, which could give you an indication of what might happen next in the world and one of the key drivers of what's happening across world markets soon. So firstly, on that political news, well, simply, the most likely options for new prime ministers are seen as a little bit soft on inflation and not so hawkish on potential interest rate hikes. But one thing I'd say, regardless of whoever comes in and whether or not that new one lasts long and another comes in, the important thing to note is that sovereign debt is so high, it puts a lot of pressure on the central bank not to increase rates. Now, we have core inflation in Japan 3.1%. And the interest rate, Bank of Japan interest rate, is 0.5%. Okay, so investors have negative real interest rates of 2.6%, going backwards by that amount. And you see this is something that we might be seeing in the US, in the UK, a lot of central banks, where you're seeing the central banks being pressured to cut rates for economic reason on the one hand, but then also for very high debt and deficits reason on the one hand. I give you a very quick quote here from a Financial Times article just to understand that there's big economies under growing pressure to keep interest rates artificially low to offset the cost of record government borrowing.
Yep.
A lot of people haven't understood that. So I think one of the big dangers, looking forward the next 3, 5, 10 years is that, savings in the bank may no longer be as safe as people think because there's rising risk of negative real interest rates globally.
All right, I'd like to bring our attention over to that point you raised there, the negative real interest rates. So we're closing into the FOMC meeting, and the possibility of an interest rate cut would be top of mind for many investors today. You recently wrote a particular article warning about the costs of negative real interest rates. Perhaps could you help us understand what the concept of negative real interest rates are and why it matters more than ever today?
Yeah, absolutely. So right now, you have seen the jobs number last Friday in the U.S. Not being very strong, and just overnight, you've seen another, back revision of jobs numbers. So there is the economic pressure, and you see Donald Trump, openly talking there about pressuring the Fed to lower rates to help the economy. And essentially that's something that's happening across the world to some extent as well. But, the debt load is still, the elephant in the room that not many dare to talk about. There's been rumors, the headline news about potentially the UK requiring an IMF bailout. Ultimately, though, what tends to happen is it's usually when debt's, hard to control, central banks are inclined and politicians are inclined to run inflation that is higher than interest rates because it's a way to control the debt burden. Imagine inflation is 10% and you just have to pay 0% interest on your debt. You actually can reduce your debt in real terms by 10%. And savers just need to be conscious of that risk because ultimately it's going to be the holders of the currencies who are sort of pressured to pay for this debt load. So as you see central banks cutting or not raising and yet inflation being very persistent, inflation actually coming up, UK 80-month high, Eurozone came up above the target, Japan still. That's a big risk that a lot of people aren't aware of.
All right, thanks a lot for that quick breakdown of what negative real interest rates are. Just very quickly, if I could get your thoughts on where you're seeing opportunities here in Asia. I mean, we're seeing how, valuations in US are, flying sky high. So is it time for investors to start broadening out beyond the US? I mean, beyond just the US or major US tech stocks and the S&P 500, are there any other attractive opportunities for investors to look at here in Asia?
Yeah, let me highlight there's basically three themes. When you look at historic valuations and, relative, U.S. versus other market and other different segments, even within the U.S., let me quickly point out that small caps are historically undervalued versus large caps. Value is undervalued versus growth. And then international markets are lower value versus the U.S. Now, we already touched on China, that we still see opportunities there. But we always like to look for quality firms across different types of markets is sometimes a bit less of a macro call than looking for quality businesses and companies. Nowadays, even if you look at companies listed in a specific country, many of them operate globally anyway, so not necessarily a macro one. Maybe one thing just to highlight, I'd be still a bit more cautious on India because valuations are still not too far from those in the U.S. It's one of the higher value markets across Asia, but otherwise a broad-based portfolio, but making sure you're not just only looking at the hottest sector and the biggest names in AI and tech space, but, broaden across style as well, looking at value, different market capitalizations, and, just hedging your bets and making sure it's in line with your volatility tolerance.
After all, diversification is the name of the game. Thanks a lot for joining us today on Bigger Picture, Martin.
It's a pleasure. Thank you.
We've been speaking to Martin Hennecke, the head of Asia and Middle East Investment Advisory at St. James's Place. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.